Hi, everybody, and welcome to Max Financial Services Planning Tuesday. Today's topic, we're going to be talking everything about refinancing and mortgages. The best part of today is I'm not going to be the one talking. I have our mortgage extraordinaire, Jayson Bates, here with us, and we're going to be talking about the refinance process, the ins and outs, and anything else that basically comes up. If you have any questions, just hop on in on the chat. We'll be able to address those for you as well. So let's get going. Jayson, for the people who may not know you, why don't you introduce yourself real quick?
Yeah, hello, and thank you for allowing me to be a part of your show here. Really appreciate that. My name is Jayson Bates. I'm a branch manager out here in Phoenix, Arizona. I've been in the business now for roughly about 23 years. Call me crazy, maybe, as the market has gone up and down quite a bit. But I really do enjoy what I do and helping people and helping people, finance their American dream. So I also host a podcast real quick at www.valleyofthesunrealestateshow.com, and you can check it out on my website there.
Perfect. Thank you for that. So I guess a question for you, since your specialty, you live and breathe mortgages. One of the things people basically might hear on TV, on CNBC or Bloomberg is, well, the state of the mortgage market. People, I either hear terms loose or tight. So kind of what's going on right now? How is it different from the past couple of years? And then maybe if you can put it into historical light.
Yeah, absolutely. Well, let's go back, the pre-recession number 2, Great Depression recession era, and it was very, very loose, right? I mean, if we always had this joke, if you could fog a mirror, you could get a mortgage kind of thing. Obviously, that was a bit loose, right? Then we had the crash, 2008. Things seemed to tighten up quite a bit. We had a lot of consolidation within our industry, not necessarily, both in terms of loan officers, the number of loan officers doing loans, and the number of companies doing loans. We had a lot of companies go out of business as a result of that. Now we're getting back to semi-quasi normal market. Mm-hmm. And so it is still tight, no question about it. And the interesting part about that is that there are companies out there who are extremely tight on their underwriting guidelines. And to some degree, they kind of choose to be that way. And for example, and I'm not going to name any names, but one of the big 4 banks just recently increased their credit score requirement for an FHA loan, for a government loan. They increased it to 640 as their FICO requirement. Okay. Where before they were 600. Now, that's a choice that they've made because the government still isn't really, in the CFPB, they really aren't too clear on their intent when they want us to lend or who they want us to lend to. Because we've had situations in the mortgage industry where we've had companies who have extended credit, but then have been subsequently penalized for doing so because they're not using prudent underwriting. And so then they take it to the extreme and say, okay, we're just going to tighten it up and we won't lend to except for the la creme of la creme, and that's all we're going to lend to, which then upsets the government. And so there's a little jostling back and forth going on politically. It's kind of there's a lot of politics involved right now, unfortunately.
But what's the deal? Let me interject. What's the deal, though? Because you do often hear how in the good old days, when you want to get a mortgage, you go to the bank, they actually take a look at everything, and it's the bank who actually owns the mortgage. Versus I had a client recently who was looking at a refinance, and he got a completely competitive offer with almost all the fees stripped out. And when he asked, well, why are you guys so much cheaper? The response was, well, we're just going to flip this mortgage to somebody else and everything ends up at Fannie or Freddie anyway.
Yeah, and that's a very good point. So we've seen a lot of companies are starting to go to servicing more, where before servicing was actually a liability, right? Because we had a lot of foreclosures. We had a lot of mortgages that were upside down. And so a lot of companies didn't want to hang on to those loans for that very reason. They didn't want to inherit bad debt. Now that the foundation has been laid and we're starting to see more and more solid performance, and the economy overall is just a little more stable than what it was. Not quite maybe where we want to be, but it is a little more stable. We're not seeing the massive layoffs and so on and so forth of companies. Now we're starting to see companies go back to servicing. And the real value of a company right now in the mortgage industry is its servicing portfolio. So we're starting to see more of those companies go back to that old school where they say, hey, look, you do the loan with us, we're going to service that loan. And the other thing that's interesting to kind of point out on this aspect is that Fannie Mae and Freddie Mac require certain liquidity of the company in order to offer certain products. And the only way to increase that liquidity is to have that servicing portfolio. So we're starting to see a lot of companies gravitate to becoming servicers. Where before that, the mortgage broker was the one, and the whole sales pitch on that was, hey, I've got every loan or every type of loan under the sun. I'm a one-stop shop. Come, do business with me. You don't need to go to the major banks because they're limited in the products that they will offer.
And
that's kind of
do the two different models do they make for the client? I mean, does it really matter?
Well, it depends, right? So I've had a lot of clients recently ask me, where am I going to be making my payments to? They don't want their loans sold off many different times. It gets kind of confusing and they really don't see the benefit in that. Where from a service aspect, if I tell them, hey, you're going to be making your payments directly to the company I represent. If you have a problem or there's some kind of issue, you can call me directly and I can handle it for you. There's a certain level of ease, I guess, in knowing that you can contact me rather than some 800 number that goes to India about your mortgage, right? So no offense to India, but some outsourced call center, rather than being able to walk in right in my office and say, hey, Jayson, this is what I'm seeing here. What can you help me with?
No, absolutely. And I mean, even from my own personal experience, we've had a number of clients a couple of years ago that they would get for mortgages, and then all of a sudden they start getting letters from a different company. It's like, hey, who is this? They call them up. Oh, well, your loan was sold to us, and so we'll be the one servicing it. And then 6 months later, it gets sold to somebody else. So it is about a comfort level as well with it. And so I guess to some people, it's worth it to pay a little bit more, knowing exactly who we're going to be dealing with in case any issues come up.
Well, not only that, but there's also just, the ease of, the companies, we still got this bad taste in our mouth that some companies went out of business. I mean, here in Phoenix, the epicenter of the debacle, we had a lot of companies go out of business right in the middle of a transaction. And I think there are a lot of people who want to know that you're going to be around for a while. And part of that is knowing that you have a good servicing portfolio, because it takes a lot of money to service loans and have that liquidity. And it shows some stability for the client in that regard.
Awesome. So I guess let's focus the conversation on the topic that we really want to spend most of the time on. Over the past, I would say maybe a year ago, when 10-year treasuries were in 1.5s every day on the radio, I'd drive and I would hear the commercials for, hey, it's a great time to refinance your mortgage, or are you paying more than 4%? Then you should be refinancing your mortgage. You hear less and less of those. Is the best time to refinance behind us, or really what's the trend for it? And at what point should people start thinking about refinancing their mortgage?
Yeah, well, good question. So it's kind of a loaded question. It's all individual. So just like financial planning, it's all about your own personal situation. And, I have some questions that I always ask people when I talk to them about refinancing and what they should be, looking at. And the first thing is you want to make sure that you have enough equity, right? Okay. And the reason this is important is because if you have low equity, then the exposure to the bank and refinancing you is much higher than somebody who doesn't have, or, that has a lot of equity. And that exposure will kind of dictate the interest rates. You may not get as favorable as a rate that you may hear on the radio or TV if you're at a higher loan to value. So you want to find out what your equity position is. And, do you have good enough credit? Obviously, credit scores play a big factor into, the interest rate that you may get. What are your financial goals? What are your long-term goals for the refinance? Are you going to be in the house a long time, or, are you going to be in the house a short period of time? And what are the terms of your current loan? Are you on an adjustable rate mortgage that you want to get into a fixed rate mortgage? That's a key one right now, especially with FHA, and not so much in the adjustable rate versus the fixed rate. But if you bought a home in the past 4 years, 4 years for the most part, we've seen a steady increase in values. to a point where you may be in an equity position now that you can get rid of your mortgage insurance, which may be $100, maybe $150, maybe only $75. But that's something that, yes, it is, I think, tax deductible. You may know better than I am. I think if you make under $100,000, it's tax deductible or something like that. But you may be able to get rid of that and take advantage of still historically low rates here in November 2015, where if you don't do that and the rates do go up as they are predicted to do over the next several months and maybe years to come, that may be taken away from you. Therefore, then when you refinance, you may get a rate that may not, offset the savings that you get from eliminating that mortgage insurance. So that's one thing to take into consideration. And then if you have a second mortgage on your home or a home equity credit line, you want to ask yourself, do I combine that first and second into one loan? Okay. And what would that look like for me?
So one of the
go ahead.
No, go ahead.
I was just going to say, it's all kind of individualized, right? Okay. So there's no real one particular answer to answer that question.
So, and I guess this is going to lead into the fee discussion of it. But is there, 2 years ago, it was very easy. So let's say, for example, if you had a 5% mortgage and now you're able to get it in the mid to high threes, it was almost like a no-brainer to do a refinance, particularly if somebody purchased their home or if they took out their mortgage over the last couple of years. But is there typically a percentage savings that you're looking for where you think it start to make sense to do a refi, as opposed to, let's say, for example, if you're currently paying 5 and your current 30 years is going to be, let's say, 4.5, 4.25, does that 50 basis points, is there enough savings to overcome doing another mortgage for another 30 years or either extending the term or even paying the fees with it? Because my understanding is, and it's really interesting, and hopefully you can educate people about this, you look at 4 or 5 different refinance truth and lending statements, and the fees are all over the map.
Yeah. So so good question. So the rule of thumb for refinancing a loan is generally if you can reduce your rate by 1% or more.
Okay.
That's the rule of thumb. Okay. That typically then will exceed, the savings will be significant enough to outweigh the cost to get the refinance. Now, that does depend on the actual cost of that refinance. If it costs you 5 points to reduce it by 1%, no, it's not worth it. Right. Apples to apples, if you're reducing your interest rate by 0.5%, the only time that may make sense is if you're taking cash out.
Okay.
Pay off other debt or something like that. But then you got to really look at that other debt and amortize that out and see, if that falls in line with how long you're going to stay in the home. You don't want to take a 2-year car note, for example, that you only have 2 years left on and stretch it out over 30 years just to save a 0.5 point. Yeah, you may save a lot of money monthly as a result of that monthly, but long term, it may not be a good solution. So you really got to analyze, what's in your best interest there. The other thing too, I will say that when you're looking at a refinance, if you are thinking about selling your home in a couple of years from the date of the refinance, you don't want to chew up the equity in the home, because remember, when you sell that home, you're going to have, realtor fees and some closing costs associated from the seller side. So you may start chewing into some of that profit that you may have from that home that you're counting on to put down on the next home. So, be kind of aware of what your long-term goals are. And, the life happens, right? So long-term goals can change in an instant.
Yeah.
Somebody falls ill, gets, sick or something like that. All of a sudden your life is turned upside down. So it's very hard to predict life events, but all things being equal, think about the long-term, goals that you're trying to get from the
Now,
home.
is it possible, let's say, for example, if you have a mortgage, you took out a 30-year mortgage 10 years ago, and the rent rates were higher, and now you only have 20 years left on that mortgage, can you do a refinance into a 20-year product, or does it only have to be a 30 or a 15 or something quote-unquote conventional?
Yeah, no, good question. You can do whatever you want. You could have an 18-year mortgage.
Okay.
Have even a 5-year mortgage. You know, it doesn't have to be your 10, 15, 20, or 30. You can do anything in between. In fact, I've even done some refinances where it's 18 years and 6 months.
Okay.
So the thing though, for pricing those loans, interest rates are based on typically a 10-year term or less, 15 to 10 years, and then 20 to 15 years, and then 30 to 20 years. So if you fall in between, like say a 25-year loan, you're typically going to get a 30-year rate.
Okay.
Okay. So the rates aren't, you know, tailored to every year that you may have.
So we learned something new. So that's actually a really good point. So if you want to refinance for a 16-year or 21-year term, you might as well go out to a 30 if you're going to be paying the same rate.
Yeah, and a lot of people will elect to do that and then pay extra.
Exactly.
It's very important, you know, especially in today's environment. The mortgages that we're doing now generally do not have prepayment penalties.
Okay.
Really not really allowed under certain rules. I mean, it is allowed under certain guidelines, but for the most part, lenders don't want any part of that for fair lending purposes. So there aren't any prepayment penalties, which means that you can pay extra on that mortgage without suffering any penalty. So like you said, you could do a 30-year term, but pay a 20-year or 21-year payment on there.
And this way, it's also going to give somebody a safety net just in case, let's say, for example, if something comes up and they can't pay as much, well, they have that option that they can make a smaller payment instead of a full 21-year payment or whatever it was going to be for them.
Right.
Well, right. Which also sounds it also sounds a little bit like the option arm mortgages.
Yeah, you do have an option. There is that word in there, right? That's an ugly
option
word.
Option arm.
Yeah, option arm.
You don't see those anymore, do you?
No. Again, because of fair lending and the scrutiny involved with those, the risk reward for lenders just isn't there. It's not worth it.
And like I said, I would say about 8 years ago, we looked into an option arm product. And if you understand the fundamentals of it, I mean, it sounds like a terrific product. It gives you a lot of options. And it's a really good tool to have in your tool belt. But I guess there's actually even 2 or 3 people that I recall seeing where they were sold an option arm mortgage, but they were sold it as a partial interest only payment, and they were surprised that every month their principal balance kept going up.
Right.
So
and that's you know, I'm glad you bring this up because you need to talk to your loan officer and you really need to interview your loan officer a little bit. I can't stress this enough when refinancing. Don't always look for the best rate or the lowest, you know, fees. There is some value in the experience of the loan officer in which you choose to do your refinance with. And that, you know, I'm not saying that you should pay, you know, exorbitant fees or, you know, a higher interest rate. Every loan officer for every, you know, good loan officer, every good company is going to be pretty competitive with one another.
Mm-hmm.
So there comes a point where you start to split hairs. And when you split hairs too much, you start sacrificing experience as a result. And that experience can cost you dearly when it comes to your refinance, because some loan officers, unfortunately, will try to push you in a direction that maybe benefits them rather than benefiting you. And that's pretty unfortunate. There are laws in place to kind of curb that. But for example, somebody may push a FHA loan over a conventional loan because the FHA loans typically have a better interest rate than what's associated with a conventional loan. But long term, that conventional loan is a much better deal. Right? Because if you're at over 80% loan to value, just as an example, on a conventional loan, you have mortgage insurance. Yeah. Once you reach that 80% loan to value, that mortgage insurance drops off. On an FHA loan, it never drops off unless you refinance, which is going to cost you thousands of dollars to refinance to get out of that mortgage insurance. So where on the conventional, it doesn't cost you anything except for an appraisal, $400, $500. So very important to interview your loan officer to make sure your loan officer has your best interests in mind, not theirs.
Yeah, that's a good point. I'm sure a lot of people, particularly in day and age when you go online and you put in your information to get quotes from 100 different people, but then it's really like, well, who are you dealing with? And in case, well, if something goes wrong, what's going to be the process and who exactly you're going to be working with? Hello, Jayson, are you there? Okay, so we have you back. But yeah, so it's I think it's very important because I think in case something does go wrong, you do want to have somebody that you can basically talk to and figure out who's going to be able to help you out with the problem in case anything arises, besides, as you mentioned, that 1-800 number to God knows where.
Yeah, exactly. And calling that person sometimes, I'm people call me on the weekends, which, my wife doesn't always like, but having that accessibility, because there's a lot of anxiety that goes along. This is a big deal, right?
Yeah.
This is not, buying, some coffee at the corner or something like that. This is a big deal. And this has long-term implications to what you're doing. And when your financial goals are. So it's very important that you have an advocate on your side rather than somebody who's just looking out for their best interest. So, so with that being said, the whole thing with conventional loans, we mentioned that a little bit. There's still a lot of people, unfortunately, that are upside down on their mortgages, and there are refinance options for that.
Okay,
right?
that was gonna be my next question for you. I mean, it all sounds great and fine and dandy in case your house actually went up, but what about if you are underwater?
Right. So that's a big, like I said, there's a lot of people that are still underwater on that. And there is you may have heard it, the acronym HARP,
yes,
which stands for Housing Affordable Refinance Program.
I've heard of it, but I have no clue about it.
Okay, so that program is a Fannie Mae program and a Freddie Mac program, majority Fannie Mae, but the same rules apply to Freddie Mac. And so that program is meant for individuals who are upside down on their mortgage, but want to take advantage of the low interest rates to lower that payment without having to do a short sale or foreclosure or something like that.
Okay.
Now there are some qualifications on that program, and it's pretty easy. Some of it though, you have no control over. Okay. So this is kind of the downside to this. And that is that you have to be current on your mortgage.
Okay.
Which doesn't sound like a big deal. However, when you call your service provider and say, hey, look, my house is upside down. What are my options? They say, well, if you fall behind on your mortgage, then we can do a short sale and then you can get out from underneath it. They fail to tell people that by going late on the mortgage, you will not qualify for another mortgage for quite some time. FHA on a short sale is 3 years. Conventional is 7 years.
Okay.
So you may be subject to renting for the next 7 years if that's what you want to do. Sometimes I guess that may not be a bad thing for some people, but you're not going to build any wealth by renting, so to speak, at least in the real estate market. So you got to be current on your mortgage. It's got to be a primary residency. It can't be, an investment home or anything like that. Mm-hmm. Second homes are okay. Your loan has to be owned by Fannie Mae or Freddie Mac. And your loan has to be originated prior to May 31st, 2009.
Okay.
Okay. If you have a Fannie Mae loan after that and the value went down, and there are some people out there who purchased homes in 2010, unfortunately, and their values went down. Mm-hmm. However, I think they're probably pretty safe right now. We're still not at the levels as far as value. I think we're like mid 2003 or something like that nationally.
It looks like depending in the area, we're like 05 even.
Yeah. So if you bought a house in 2010, you're probably not upside down on the home, thankfully, anymore. And your loan to value has to be greater than 80% loan to value, which sounds kind of crazy. If you're upside down, you're going to be more than 100% loan to value. But you can go to, and I want to read this. I wrote this website, this phone number down here for Fannie Mae. If you want to see if you're eligible, you can call Fannie Mae. You can call them at 1-800-7-FANNY from 8 a.m. to 8 p.m. Eastern Standard Time. And they'll tell you whether or not your loan is eligible for the HARP refinance. Now, if you have a Freddie Mac loan, you can call them at 800-FREDDIE, same time, 8 to 8. And they'll tell you whether or not you have a Freddie Mac loan and whether or not it was done before May 31st, 2009, and whether or not you're eligible. So that's a good resource for somebody who, in lieu of doing a short sale, I hear realtors tell people all the time, hey, I'll just do your short sale and I'll pay you, or they'll pay you to do a short sale. Mm-hmm. not always advantageous. And some people feel like they're kind of being forced out of their home, and that's never a good feeling, like they have no other option. So the housing HARP, Housing Affordable Refinance Program, is a good viable solution. Now, the other thing too I want to mention here real quick and kind of piggybacking on that is if you have an FHA loan, there is what they call a short refinance through FHA. Okay, so this doesn't really apply to a whole lot of people, and it's kind of interesting that this even came out. But FHA loans became fairly popular, 2010, 2011. Prior to that, we had a lot of 2008 and before and prior were a lot of 80-20 loans, these kind of creative financing deals, right? So they really weren't too many FHA type programs or, a lot of people in the FHA market. But FHA does have a short sale or short refinance program. Now, on both of these programs, you just can't call anybody to do these. In other words, if you called me today, I would ask you who your servicer is, because here's the caveat on these deals. No lender wants to inherit bad debt, right? So if you're upside down on your loan, a new lender is not going to say, hey, you're upside down on that loan. Why don't you come over and make your payments to me because you're upside down? That's just bad business for lenders, right? But if you're already on the books for that servicer, they have a somewhat of an obligation.
Okay.
Per the government, there's a lot of political pressure put on the lenders to get those people into a more affordable situation. And so you have to go back to that servicing provider, servicer, whoever you're making payments to, and then they will walk you through that process that they have internally to accommodate the FHA short refinance or the HARP refinance. Okay. But to do some due diligence up front, you can call Fannie Mae, Freddie Mac, and they'll tell you whether or not you're eligible. And then you call your whoever you're making your payments to, and they'll walk you through the process to help you.
So here's the thing. What about for the people who have been having issues, and I've known a couple of people who have been have not made their payments in a couple of years. They're still living in their house. They would want to remediate the mortgage. I mean, they would want to go back and I guess, let me look for a better word. They want to go back and they don't want to default on a loan or anything else along those lines. But in a couple of those cases, the lenders basically said, well, now basically come up with all of the money for the last couple of years, and then we'll start talking to you. Do those people have any options?
Well, it's a tough situation when it comes to those. It depends. If it shows on the credit report that they have been late, then no, they really don't have many options. If the lender does not show that it's late on the credit report, which is very few and far between, okay, they'll tell you they'll take some kind of, they'll cut your payment in half or something like that. And if it's a new note that they actually generate for the new terms, then you're probably going to be okay. But in a lot of cases, even to generate that new note agreement, so they're having an addendum to your original note, so to speak, to reduce the interest rate and reduce the payments. In order to get that addendum, a lot of times they require that you go late on the mortgage, right? And so unless you have at least 12 months of payment history on the addendum to the original note, you're pretty much in trouble. But if you have 12 months seasoning that you've made that payment on time for the new note agreement, then you have some options. You do have some options, and FHA will allow for that sort of thing. VA will allow for that sort of thing. Fannie Mae, Freddie Mac won't allow for that because they look at a 24-month history typically on that.
And is that for refinance or just kind of to go back and make their mortgage current?
Well, you always have the option to make your mortgage current. You can always, if you come into some inheritance money or something like that, you can always, as we said before, prepay or pay that lump sum, the deficiency balance, if you will, and bring it current. You always have that option.
Okay.
So there's no problem there. But yes, for refinance, if I were to pull somebody's credit and they had, a lower payment from the original note agreement, then I'm going to look at the credit report. All the emphasis is going to be on the credit report and how that's being reported to the credit agency. And that's one key factor that when we entered into this whole mess, right, there was a lot of unknown. Short sale. Who knew what a short sale was prior to 2010, right? A foreclosure, yeah, we knew about foreclosures, but not to the extent that we have or had before. So a lot of agencies, a lot of credit agencies weren't really sure how to even report a short sale, right? They didn't even know how to even articulate that, if you will, on the credit report. So they put, paid in full for less than balance owed, or, they put other kind of verbiage on there. And so I have seen creditors actually report on the credit report, the balance is just paid in full. In which case then you're good. Yeah. You're one of the lucky ones. Okay. And some of the bigger agencies, especially that had a lot of servicing and a lot of things coming down the pipeline, made those kind of mistakes. So, I know here in Phoenix, we had just lines wrapped around, University of Phoenix Stadium for people taking their paperwork in, going to talk to attorneys and financial planners or the banks themselves, saying, here's my paperwork. How can you help me? And sitting in for days waiting to get, camping out. You think it was like the, Star Wars, kind of episode.
The new iPhone
kind of
release.
Yeah, the new iPhone release, right? But it was very desperate times. And so there was a lot of uncertainty as to what it would look like. And that's why a lot of creditors, unfortunately, told people, hey, you got to fall behind before I can help you, because I have to show a hardship. And I can't show a hardship if you're making your payments on time.
Exactly. Yeah.
Even though you encountering a hardship in the near future, I have to show it now. And that's really hurt a lot of people. And that's what has made this housing recovery take so long, quite honestly. It could have been solved in a year, really, if the banks would have taken the other steps. Why would you want a foreclosure? I'll make the payments on it. I just can't afford to make these payments because my hours at work got cut to this, or I got, I'm underemployed now, and all these other kind of things. And so the answer to that question, in short, and you may know more about this than I do, but when these mortgages are pulled together into a security, if one of those mortgages goes bad, or multiple mortgages go bad, it ruins that security. And there are investors who rely on the performance of that security for their retirement funds and things like that. So, it's not as easy as just taking a mortgage and saying, hey, yeah, we'll just reduce the balance and you continue making payments, stay in the house. Yeah. They'd rather not do that.
So for the people who do have those hardships, or who are behind in their mortgages, what options do we usually have?
Yeah, it's really tough. You really need to talk to your service provider. There are programs through like VA and the government who will help. There are classes and things like that will help guide you through that process and letting you know what your rights are as a consumer when dealing with that. But as far as a refinance, there's really no option there. Either you're late or you're not. Yeah. So the next step is to try to keep the house. And that's really, unfortunately, because of the political pressures, that's really the bank's discretion right now. The government says, hey, we want you as banks to play. We want you to come in and we want you to loosen the guidelines. That's the foundation of what holds the economy together. I mean, the more homeowners we have, the more stable our economy.
It's the American dream, that house with a white picket fence.
Right, exactly. And if you buy a house, well, you're going to go to Home Depot, you're going to go to Lowe's, you're going to do this, and you're going to put money into the economy. It's just how it works.
And then house prices go up, and then your house becomes an ATM.
Right. And we are starting to see that happen a little bit more now. Going back to the original, it is loosening up a little bit. I had a podcast before about credit trends. This is the new thing kind of coming down the pipeline here. Next year, Fannie Mae, Freddie Mac are going to start incorporating credit trends into the algorithm for qualifying people. So what that means is that if somebody pays off their American Express, for example, we will be able to see as lenders that you actually paid off every month, rather than hitting you with a minimum monthly payment. So what's critical about that is that typically 9 times out of 10, I pull somebody's credit, it shows that the American Express is maxed out. Therefore, when it's maxed out, it reduces your credit score. Therefore, you get a higher interest rate, or whatever the case may be. You can't go as high on the loan to value to do the refinance you want to do. So when I see credit trends, I'll be able to see that you actually pay that off every month. A lot of people have business accounts that they pay off through their business every month. And so the credit snapshot for that individual, having a high credit balance, is not indicative of who they are as a credit risk when they pay it off every month. And so we're starting to see Fannie Mae take notice of those sort of things and say, okay, well, we're gonna incorporate those into the algorithm for our credit profile, and therefore not hit people for that risk factor.
Perfect.
Of being maxed out on credit cards.
So it just seems like technology is kind of making it easier to go back to the old way of lending money, of actually looking at the entire picture besides the debt to income and your credit score.
Exactly. And DU, desktop underwriting, that's the underwriting engine that's used for lenders. DO is desktop originator. With those underwriting engines, LP is loan prospector for Freddie Mac. Those underwriting engines are only as good as what you input into them.
Yeah.
Right. So, but they're there to take out some of the subjectivity of an underwriter actually looking at your credit profile. Unfortunately, I've had underwriters who are disgruntled. Maybe they just recently got divorced and they didn't get the money they were expecting to get. And therefore, when you see somebody who has gotten what they deserve to get in a divorce, they may hold that against the person. So the whole goal of having the automated underwriting is to take that personal connection away from the underwriter and just look at it subjectively. But that's been a good thing.
But can't you make the argument that if you're taking the human out of it, that you might also tighten up, and you might not be able to either make, not necessarily, I guess in the long term, it might prevent you from making a good client out of it by extending to them the credit that the computer might not have originally done, but you kind of just use, I guess this is the biggest computer we have. You just might might have a sense that, hey, you know what, this person has been making progress. They have been paying down their debt. Yes, they did just switch for jobs, but it's in the same field, it's in the same career, and now we're making moves up.
Yeah. No, it's a very good point. And you're never going to take the human element out of it. It's just not going to happen. But having something that is kind of putting in some of the emotional aspect of underwriting is a good thing, right? When it comes to underwriting, there are always going to be those situations where it's going to require a manual underwrite. Now, the problem with manual underwriting, and what I mean by manual underwrite for your listeners, is that an underwriter disregards the automated underwriting engine and really looks at the totality of the exposure to the lender in lending you money. Okay. And so that, unfortunately, though, from underwriter to underwriter is subjective. And so they're trying to eliminate some of that to further shore up that foundation and just make it, pretty cut and dry. Either you qualify or you don't, kind of thing. Now, there are situations in a divorce situation, and I use this quite often because it's something that unfortunately hurts a lot of people. You may have joint accounts with your ex-spouse. The ex-spouse, in an effort to get back at you, doesn't pay on that account. Therefore, then it hits your credit score. That's unfair, right? But in underwriting, they look at it and say, well, you still have an obligation to that creditor, whether you're married or not.
Correct.
And so, and each state is a little bit different, right? Here in Arizona, we're a community property state. So it's 50-50 right down the middle. Other states aren't like that. So having that uniformity across states with different laws is difficult. And one of the ways to do that is through an automated underwriting engine that can try to encompass as much as possible. I mean, they're predicting with that, just that change right there, they're predicting that it could increase the amount of people who actually qualify for a mortgage by 20%.
Wow.
Which is a big number. I don't know if I believe that or not. That might be one of those, George Bush fuzzy math kind of things. But anything is better than nothing, because more of the homeowners that we can get into homes, help stabilize that. And the other thing too, I want to mention real quick on that is that they're also starting to incorporate pay stubs into that algorithm. So if you work for a company, for example, that is affiliated with the work number for verification of employment, DU or DO and even LP will be able to pull your work information from the work number when the lender runs that through.
Wow.
Therefore, you won't even need a pay stub. You won't need tax returns. You won't need, whatever the case may be, W-2s, for example. And so that may make it a little bit easier, which will take some of this pain out that everybody's felt over the past 5 years and how difficult it is to get a mortgage. You got to give your right leg and left arm to the mortgage company and, your fillings too, just to get a house. This may ease some of that tension there. And that's due to be released too in 2016. They're predicting right now about mid 2016.
Well, I'm just waiting for the people to start coming out and start realizing how much big brother, big data there is out there. And it's like, well, at what point is it enough? And I guess, what's funny is earlier today I was in bed and I had my iPad and my iPhone. On my iPad, it said there's a new feature. And now you don't need to press and hold the Siri button. You can just say, "Hey Siri," and it's there. And it kind of makes you think, well, your microphone's always on. It's always recording you.
Yeah, good point, right? Good point. They're trying to make it easier, but sometimes, we all know the government kind of gets in the way of itself, right? So government says on one hand that they want lenders to extend credit to more people. Yet they don't want it to get so loose that it was back in 2005, 2006.
Yeah.
So, I have seen, to give you some examples here, I have seen some more emails come across my computer or my desk in relation to stated income.
Okay.
Stated income is trying to make a comeback, the liar loans, so to speak.
Yeah.
Now, I think there's a place for them.
Self-employed.
It just has to be, right LTV, right exposure, maybe not investment properties, primary residencies, good credit scores, maybe 12 months reserves in the bank, or, there's a certain profile that would work for. The problem that we get into in the refinance and in the mortgage world is that we try to extend that to everybody because of fair lending.
Yeah.
And that gets us in trouble a little bit. And so people are a little gun shy. Lenders are gun shy in extending those kind of things. And then the last thing too is if we did that, then would we lose some of the Fannie Mae programs that we have at our disposal currently as a result for extending credit on risky loans? And then how competitive would we be in the marketplace by losing some of those loans?
Well, and it's interesting. I guess I'm in the belief that I'd rather have all the tools available out there. So even on the investment side, I don't necessarily think that there's good product or bad product. I think it's whether it's appropriate for you or not. And it seems kind of like in the mortgage world. So kind of going back to the stated income, looking at the option arm, I guess as a professional, you can basically see, hey, there's a clientele that can definitely benefit for this product. I guess really the issue becomes when the selling features of the product get peddled to people who really don't know or shouldn't be in that product in the first place. And it ends up blowing it for everybody. Yeah,
absolutely. Few bad apples ruin the whole basket, right? Yeah. So same thing goes in the mortgage world.
Wow.
It's kind of interesting though, because in the mortgage world, we have a lot of scrutiny. We've had some changes here with, in the way that we disclose things that rolled out October 3rd with TRID, the TILA RESPA integrated disclosure system. So we've had some of those things kind of come out from the Dodd-Frank Financial Reform Act. Yet, I just purchased a car about 3 months ago and they didn't even ask for a pay stub. Yeah. And it's a $60,000 car. It's like, good grief, man. That's still a lot of money, right? But they don't have the same scrutiny financially. I guess their lobbyists have more money or something, or better arguing than real estate lobbyists. But there is we were, I feel, somewhat the mortgage world, isolated in that we were a scapegoat. I feel. Now, again, if it's used, if the products are used properly, they're great. For example, VA loan. VA loan is 100% financing. That is one of the best performing loans that's out there. Yeah, it's 100% financing. And people say, well, you got to have skin in the game. That was a big argument. You got to put money down. in order to, if you got money into it, you're less likely to walk away from it, kind of thing. Well, a VA loan is one of the highest performing loans. They're on the books, and it's 100% financing. Now, the key to that, and that is that you have to, as an underwriter, when doing those loans, you have to take into consideration the residual income factor. Okay, so we talk about debt to income ratio, DTI. 45% is typically the threshold for that. On a VA loan, you also have to have residual income, and that residual income is the amount of income that's left over after paying all your bills.
Okay.
So that they know that you have income for groceries, light bill, gas bill, whatever. And that residual income is set by the IRS. And if you meet that residual income threshold, they really don't care what your debt to income ratio is. So because they know after taxes are taken out, everything's taken into consideration on that. You've got, on a $2,000 paycheck, you've got, say $800 left over after that paycheck to pay for your groceries and everything else. Then you're in pretty good shape to make that payment on that mortgage.
Yeah, absolutely. Because think about it, that makes so much more sense when you're looking at, hey, how much money do you have left over, as opposed to, well, you just want to make sure that you don't spend more than half of your income on your housing bill. In reality, it's, well, we don't look at how much money the other person is spending on anything else. They might have a Starbucks habit, or it might be going out to eat every single day. And that would dig up a lot more money than the mortgage.
Well, and it's based on gross income, right? For the traditional, Fannie Mae, it's gross. It's not even after taxes. So people, hey, I only take home $1,200, but I make $2,000 or whatever after my insurance and everything else and taken out, but I'm going to calculate it on the gross income, whether or not they qualify. And so people can get in trouble real quick.
And that's even a really good point, because now more and more people, if you're going to have your health insurance plan, that's going to be coming out pre-tax, and the premiums are going up. If a husband and wife in New Jersey, and you're easily paying over $1,000 a month, it's right there. It could be 20% of your income right there that you're spending, and between 20% on healthcare, between 20% on taxes, and then 40% of housing, you have no money left over.
Right. And you become house poor very, very quickly. And right now we're kind of going through this nice period of gas prices relatively low, right? But think if gas prices go back up to $4 a gallon.
Yep.
That cuts into, expendable income.
Absolutely.
As well.
That's a couple $100s a month for most people in this area anyway. So,
right.
Awesome.
So, there has to be some changes, but I think we're on the right direction.
Good,
going in the right direction.
So this was really, really helpful. We've been talking about this for almost close to an hour, and we got a lot out of it. We got a lot of concrete things from the discussion. So I guess kind of to sum it up, if somebody's thinking about a refi, what are some of the 2-3 things everybody really should be thinking about and keeping in mind, either from the decision-making process or while they're going through the process of doing a refinance?
So good question. So some of the things you want to ask yourself: how long is it going to take to close the loan? You want to see if that fits in your lifestyle or what you're looking to try to accomplish. What are the closing costs? You want to factor out what are the closing costs versus how much you're saving in the loan. Are there any additional fees to the refinance outside of the closing costs? Is there any surprises? So, like an appraisal. If the appraisal comes back and it says that you have termites, for example, I might have to have a termite inspection done. There's things. The appraisal for the lender is the eyes and ears, if you will, for the lender. So if something comes back on that appraisal, don't call a lender if you're in the middle of redoing your kitchen and there's no kitchen, because the lender is going to look at it and say, okay, well, there's nothing forcing me for you to finish that kitchen. So now I have a property that is compromised because it's not sellable, or it's not sellable at the highest price. Right. So, if there are additional fees of things that you need to take care of as a result of what they find on the appraisal, is there any prepayment penalty? Like I said before, there's really no prepayment penalty anymore. And also, when can you lock in your interest rate? Now, that interest rate being locked in, not many people know this. You can actually lock in your interest rate up to 6 months.
Wow. That's long.
And refinance, that's a long time. You're going to pay a little bit of a premium to get that. You're not going to get the best rate to do that, but you can lock it in. So if you're doing like a new construction, for example, and that's a purchase really, But even, maybe you're taking a refinance out or something. I don't know. You can lock up to 6 months. Now, on a refinance, it's, generally right now with TRID and everything like that, you're going to be able to close that loan. Typically, at least here in Arizona, is anywhere from 30 to 45 days. Is how long it should take. Now, most major banks are 60 days, sometimes even 90 days. So that's why you want to ask, how long can I lock in my rate for? How long is this process going to take? That sort of thing. But those are some of the questions that you probably want to ask yourself before you get started. And again, going back to the original one, how much equity do I have?
Yeah. Perfect.
Is that a factor into it?
This is really, really, really good. This is really helpful. Awesome. And I think our audiences, they have tangible takeaways. They have tangible questions. They can talk to their mortgage professional. And in case they don't have one, why don't you give your contact information out again?
Yeah, absolutely. I'd be happy to talk to anybody about their mortgage needs. Again, Jayson Bates. You can visit my website at www.Valley of the Sun Real Estate Show, or you can call me. My phone number 602-573-3101. I'd be happy to answer any questions you may have or concerns.
Awesome. So this was really helpful. Thank you, everybody, for tuning in. We'll stop the recording right here. And if there's any questions, we can open up for those. So, Jayson, we had a question come in, and this is actually one of the topics we wanted to cover, but we didn't due to time. One of the things that most clients are going to have an option with, particularly if they have equity in their home, is instead of doing a refinance, why not do a home equity line of credit? Or more specifically, why not do a home equity loan, which may just be a shorter mortgage, if I'm not mistaken?
Yeah, so let's kind of cover these three things here, because most lenders, not most, but a vast majority of them are going to try to look at the overall picture for your situation. Okay, and they're going to ask you the questions we talked about earlier to see what your goals are for the home. And again, this all comes back to your own individual, what your intent is with the home. Okay, home equity credit lines are good loans because they allow for you to take money out as you need it, pay it back, and take it out. It's kind of like a big credit card, if you will. Exactly. The bad side on those, that they are a variable interest rate. And with interest rates starting to at least be considered to be raised by how much, we don't know yet, that may not be a good option for you. So what you can afford today may not be what you can afford later. The other thing too about home equity credit lines that's important to note is that you need to look at if you get a home equity credit line for $50,000, for example, find out what the payment is on that $50,000. Don't say, well, hey, I'm going to get $10,000 today, and my payment's only going to be $75. Therefore, it's affordable. Yeah. Think about if you do have to withdraw the entire amount and whether or not that's going to be affordable for you, because home equity credit lines can be a little dangerous when it comes to that. They can be a little deceptive when it comes to that. Yeah. And then a straight, just an equity loan, if you will, that's a fixed rate, typically on a 15-year term as a second mortgage. And you get the lump sum of cash or debt consolidation or whatever you're looking to try to do with that second mortgage. You get that all in one lump sum. Yeah. That then you could take and reinvest or do whatever you want to do with it. Maybe put it in some kind of investment vehicle where you could take cash out from it.
Yeah. Well, my question was more specifically, and we have a client that we were working with, and she had a mortgage, and she actually ended up paying it off. And instead of doing it as a mortgage, she just took out a 10-year home equity loan with a fixed rate of like 275, and she was paying it off. So not necessarily using it as a cash out like you would do with a HELOC, but rather a fixed home equity loan instead of a refi where you have no fees. There are no closing fees or anything else like that.
Yeah. Yeah. I think Chloe may want to answer that for us, but
Zoe, not Chloe.
Yeah, no. Well, I'm sorry. What was her name? Did I mess that up? Zoe. Oh my goodness gracious. So yeah, in those situations where you have a free and clear, that's pretty unique, right? So a home equity credit line is a viable option in that situation because you may not need all the equity taken out of that home. You only need part of that equity. And so you don't have to, the problem with taking out just cash or taking out just one loan is, like I said, it's a one lump sum, whether it's a first or a second mortgage. In her case, a first mortgage. where a home equity credit line allows the flexibility of you being able to take out what you want when you need it. Where the fixed rate is, hey, your payments are based on the total amount that you take out, not what your balance is.
But can't you, if it's a small enough balance, and let's say, for example, you have 5 years to pay off your mortgage, or you're able to afford a 10-year payment, can't you refi your mortgage into a home equity loan?
Sure, absolutely. You can take home equity loans are really loan to value based, right? So I don't see too many home equity credit lines at 90% loan to value. They're out there, but they're pretty expensive, right? They're typically at 75, 65% or less.
Okay.
And so that's why the popularity of the home equity credit line isn't as popular as it was back when we were doing 80/20s and some of the other crazy financing that we were doing back in 2006, 2007. Because the problem is with those types of second mortgages that, yes, they can be used as a first mortgage, but those type of products, they're the first usually to go if we were to have a downturn in the market and values were to come down. So essentially they become unsecured debt at that point, in which case then people just don't pay it. And then, there's a lot of loss. But so they try to restrict those loan to values quite a bit. And if you're under 65% loan to value.
So I was going to say, it seems like it is something that is plausible and might work, but I guess just most people aren't in a position to do that.
Exactly. Most people aren't in the equity position to do that. Or right now, maybe they paid cash for the house, right? And they're little, they've got some cash. There really hasn't been that dire need. And I think there's even a little hesitation within the market to use your house as a bank, right? So there's some hesitation, I think, going on there too, which is good. That's a good thing.
Perfect. Awesome. Well, I think that addressed that question. And now we have more people joining us. So at this point, I'm going to stop the recording and we'll open it up for Jay, John, Joe. We have all Jays in there. If anybody else wants to hop on, we'll have Jayson first.